All right, guys, we're back again with another great episode of PFREI. I'm your host, Fuquan Bilal. We got another great episode today. We got Steven Ware from Triple SE. So I
Thanks
want
for
to say
having
that
me.
I want to say the name, Steven, because it's a tongue twister. Storage syndicated, no storage syndicated equities, Triple SE. Storage,
Self-storage syndicated
self
equities.
storage syndicate. There you go. That's Triple SE. Awesome. Now I love the name, man. Um, so yeah, I had your partner on. We're gonna talk today. We're gonna get into it. I had your partner on maybe like a month ago. He was in Brazil, and you said he's still in Brazil.
Yes, he is.
That's the real estate life, but that's the self-storage life, I should say. We'll talk about that. But yeah, welcome to the show. I really appreciate it. I'd like to get people on the show who are actually active in real estate, so they can add value not only to the people who's listening. There's a lot of new people who may be listening, but I like to bring people who's actually doing the business. There are a lot of people out there who's teaching the business and not actually doing. So I know we're going to get tons of value today, but welcome to the show, man.
Thanks for having me.
Awesome. So just tell the audience a little bit about your background and I know you had some experience with marketing. Am I correct? Doing some
Correct.
marketing. Let's talk a little bit about that and your transition into real estate. So you did some advertising and stuff like that, and I know you graduated from what's that, UIUC?
Correct.
All
Yes.
right. So let's talk about that and how that helped you transition into real estate, because that's a whole different
A
type of
little
thing, but I
different.
know it's helping out a lot with what you do now. So
Yeah, I like to say that at the heart of all of our real estate businesses, they're marketing companies. So that's what's allowed us to kind of change from asset class to asset class. Now, I think we've come across our forever asset class of self-storage, but I could be made wrong in the future if we come across something even better.
yeah.
But yeah, my background is in advertising. I went to University of Illinois Urbana-Champaign, actually originally to become a sculptor. And then thankfully, a very bright guidance counselor sat me down and said, Steven, are you a very materialistic guy? I went, I don't think so, but why are you asking? They're like, well, unless you answered a vehemently no to that, I think you should probably be looking at some other majors. And so the suggestion of advertising was originated from the idea of taking business and art and combining them together. And I
Mm.
don't know if that's the reality of what advertising is, but it ended up being a natural fit. And I ended up going on and working for some great branding, public relations, and advertising agencies post-college. But it was due to my business partner, who was my randomly assigned freshman year roommate at University of Illinois Urbana-Champaign, Fernando Angelucci, that got me into real estate. Since Fernando always knew that he wanted to get into real estate, but his parents required that he go to college. And so he was out in Iowa working for a Fortune 50 company, and he started sending me pictures of checks. And I was like, these checks don't say Grandma Angelucci on them. It's not your birthday. I don't understand why I'm getting photos of these to begin with, but I also don't know where these checks are coming from because they don't say your company name on them either. And it turns out he had started wholesaling residential real estate. Now, like most people that aren't in real estate, I had no idea what wholesaling was. And so when he explained to me, I put a property under contract, I make sure that contract is signable, and then I sell the contract to somebody else who steps into my shoes to buy that property. I said, that sounds pretty interesting. And I like these numbers that you're sending on the checks, and those checks are bigger than the money that I'm making at my advertising job. So count me in. So I ended up jumping out of a plane and building a parachute on the way down, since I quit my job and then promptly sent out 42,000 direct mail pieces in the first month of me doing residential real estate wholesale. Now, I didn't have a buyer's list. I didn't have contractors yet. I had never done a single real estate transaction outside of my personal condo that I had bought. So you can imagine that 42,000 letters, that became a problem in terms of response rate, especially since the response rate on that mail campaign was 13.2%.
Wow, that's incredible.
It was our best response
Incredible.
rate to date. Yeah. So,
Sounds like a lot of pressure.
oh yeah, oh yeah. It was one of those things where I was using a Google Voice number, and then had a spreadsheet that I was taking down all the information from. I had no CRM. I was just doing it all based on the Google Suite products. And by the time I would finish a seller call and hang up, I would have missed 2 other seller calls. So it was definitely a problem, but it was one that kind of was trial by fire and ended up being something that kind of put the gasoline on the fire for getting some money in my pocket pretty quickly. Although it did take about 6 months for the first transaction to clear. From there, we ended up building a residential portfolio of rental properties, since that's kind of what we view as the kind of normal life cycle, is that you start wholesaling properties and you start holding on to some, maybe you do a couple fix and flips there, then you realize you want to get some of that passive money. So you end up doing a couple rental properties. So we had built up a rental portfolio in Chicago, as well as in Indiana and in Iowa. But already we were starting to feel like we were getting burnt out. And we were young guys, we're still young guys, but we were even younger then. It was like, this isn't going to be a 25-year timeline if we continue on this trajectory. And so thankfully, Fernando put out some feelers, and through his attendance to various conferences and whatnot, he came across self-storage. And Fernando's the type of guy where he has an insatiable appetite for learning. So I had heard this many times before of like, oh, we should get into the notes business. Oh, mobile home parks. And so he said self-storage. I was like, Fernando, like one more thing for us to have shiny object syndrome on.
The
like,
shiny squirrel syndrome.
So we ended up going out to Indianapolis for this academy on self-storage. And I was sold pretty quickly on it. And we just jumped in both feet. We ended up selling off all of our residential properties. And we've been committed to self-storage ever since. And that's also a shout out to Scott Myers, who I think you may be familiar with, since he's in some of the masterminds. I think that you're
I was just actually with Scott 2 weeks ago in San Diego.
Wonderful. Yeah, no, we love Scott. Scott's been a great friend and mentor. But he was the one that was hosting that self-storage academy, still hosts those self-storage academies. So for anyone that's looking to get a very intensive grip on self-storage, I would definitely recommend Googling that.
Yeah. So it's your network is your net worth. So,
Amen.
Being in the right circles will definitely help catapult you to the next level. So yeah, I remember speaking to Fernando, and he transitioned to thinking he was going to do multifamily. And then he said, you know what? I'm doing this self-storage because it's like multifamily without like the leaky toilets and everything else. So he's like, can you imagine that? Like, you're not getting maintenance calls, but you still get the return.
Absolutely. I mean, that's the headline for self-storage is no toilets, tenants, or trash.
I know. And I'm like,
pretty true.
I'm just really over the last 3 years, maybe 3.5 now, transition into buying bigger multifamilies, because I had smaller ones, and I'm like, okay, the 150 unit, way to go. And we've been doing a lot of that, and it's a lot of work. And when I speak to different guys in my mastermind that's in self-storage, I'm like, wow, is the grass green on the other side? But I know you guys have challenges there also. It's not, all bells and whistles. I'm pretty sure that it's real estate, right? So it's probably less drama with people. Well, I wouldn't say that, because I've heard the storage stories, but I just know it's a different animal, and it's probably it's recession resilient from what I know about it. So let's talk about that now, especially where we are in this market. Well, actually, I didn't even ask you the question I usually ask all my guests. Why are you passionate for real estate investing?
The vehicle. I mean, you mentioned at the start of the podcast that my business partner Fernando Angelucci is down in Brazil. He's been in Brazil since September, and the business has kept on going. And that's a testament to Fernando and his drive, but it's certainly a testament to real estate. And that's what I realized while I was in advertising, is that while advertising at the time was my passion, and I really didn't give real estate two thoughts, I recognized that real estate was going to be the vehicle that got me to my destination of time freedom as quickly as possible. And I mean, me and Fernando have been doing real estate now for 7 or 8 years. And it's the point where, we can take these kind of quasi sabbaticals where Fernando's been gallivanting around Brazil for the past 6 months. He's been working as well, but I'm sure he's had his fun. And so that's what drives the passion, because I recently saw a study that was very interesting where it showed these different charts, these different line graphs, and it showed how your time was spent based on your age. And the various categories that it went through was with friends, family, romantic relationships, work, and alone. And it was fascinating to see that a good portion of our lives in the middle, we spend with work. And so that's really something that we need to take in mind, that we have to enjoy what we're doing. But also, we have to recognize that if we can take any steps to shorten that period of time where we are spending the majority of our time, not with our friends, our family, our romantic partners, or even by ourselves, but instead with work, if we can shorten that time, that's something to consider. And that's what I did consider and what I took up when I took real estate on as my profession. And I've made it my passion, partially because I'm more passionate about my friends and my family and my romantic partner. So I will do whatever it takes to make more time with them. And real estate has allowed me to do that. And it just so happens that real estate's a very enjoyable profession to be taking on. And it's something that I'm passionate about, partially because I get to meet people like yourself, where you've got passion. And I know that you're not doing this podcast because of just real estate. You're doing it because of all the other nuggets of knowledge that get revealed along the way of real estate.
100%. I am a junkie. And this is my therapy session.
There you go. There you go.
No, that was actually a really good, profound answer, because it resonated with me. And it made me think of, I need to start doing more to cut the time down from work. So thank you for making me feel more guilty. I really appreciate it.
Well, what's therapy without a little guilt, right?
No, I love it. Thanks for sharing. Let's try to change gears a little bit and talk about the marketplace, right? So interest rates are double than what they used to be. So you can't get money cheaper than you used to, which affects cash flows, which sellers, I don't know if they still got their head stuck in the sand, but they need to cut prices in half so we can start buying stuff, right?
Yeah.
How is that playing out for you? And what challenges do you guys have in the multifamily? I mean, sorry, no disrespect, in the storage space.
So storage space, just like multifamily, is also a commercial real estate asset. So the bad news is that it's experiencing a lot of the same issues that multifamily is experiencing as well. I do see the lag where there has been the increase in interest rates, but not necessarily an increase in cap rates and a reduction in purchase prices. The good news, though, is self-storage is the most lendable real estate asset there is. So right now, with the bank uncertainty that's been caused by Silicon Valley and Signature and things like that, banks are looking for assets that are able to collateralize their deposits and make sure that they are functioning at a high level. And self-storage has the lowest default rate of any real estate asset. So just something to consider, that during the first, I believe, 3 quarters of 2020, so in the pandemic, when things were really hitting the fan, multifamily ended up defaulting 18 times higher than self-storage did. 18x more than self-storage. Out of the, I think it was like 1,800 CMBS loans that were issued in 2020, I think only 3 that defaulted were self-storage. So and that statistic may be a little off, but I know that it was incredibly low, and I do know it was 18 times that of self-storage. So banks love self-storage, and that's the good news, is because they still want to lend to it. We're finding that we're getting better interest rates and better terms than a lot of the other real estate assets out there right now. Additionally, it's caused us to look to alternative means to banks. So one of the most typical avenues that's an alternate to a conventional bank is going with seller financing. And so we've found that a lot of these self-storage owners are open to that, partially because they're used to this relatively passive income. I mean, not truly passive where they don't have to do anything, but they do have a fair amount of mailbox money that comes in. So the premise of interest income coming in is something that's attractive to them. as well as the fact that a lot of self-storage owners, maybe libertarian would be the best way to describe them. But for instance, I was talking with a self-storage owner this week that told me that he was 100% interested in doing some seller carry of the purchase price, particularly because he didn't think banks were going to be around in 5 years. On top of that, he requested that we make our monthly interest payments to him in silver bullion. And I said, hey, I get it. I understand it. It may sound a little comical, but I understood where he was coming from, partially because I've talked to hundreds, if not thousands, of self-storage owners. And I said, hey, if your financial team can work out a way for us to do that in a logistically sound way, where I don't have to be, making a flight with a pallet of silver bullion every single month, I am certainly open to it. The other alternative ways that we've been looking at institutions like life insurance companies, because of self-storage, the self-storage's recession resilience, as well as its low default rate. You've got these institutions like life insurance companies that are looking for the quote unquote safest place they can put their clients' money. And self-storage has often come up at the top of their list when they try to diversify into real estate assets. And so we've been able to get some pretty fantastic terms from life insurance companies. Like, for instance, one of the last loans we got in the last couple of months ended up being a 10-year loan, I believe is 25-year amortization, and it was a sub 5% interest rate.
Wow, that's amazing.
That felt pretty good for us and our investors.
Yeah, especially during these times, right? What are there any challenges you're seeing as far as delinquency? So because inflation, right? So your client base, a lot of these people are not wealthy people. I mean, I would presume that these are middle class or people who the cost has gone up, they're not getting raises. So of course nobody wants to lose the storage because they have, valuable things there. But are you guys seeing any delinquencies or anything that you're trying to mitigate or get ahead, or running certain specials or reducing pricing because of where we are in the marketplace? Or you're just standing firm trying to meet the pro forma?
So there's a couple things to unpack from that. The first one being that self-storage, fortunate for self-storage, not trying to make light of the pandemic in any means, but self-storage performed phenomenally during the pandemic. Across the industry, there was 7% month-over-month growth in rental rates, which was incredible for a 2-year period. So right now we are seeing some of the more primary markets, so like your major MSAs, we're seeing self-storage facilities in those markets kind of wind back some of their aggressive rate hikes. But once again, I mean, if you're raising your rental rates greater than 100% over the past 2 years, and then you're having to take a 20% haircut on it, I think you're still pretty happy with those rental rates. But we're seeing that primarily in those larger markets. We tend to buy self-storage facilities and we tend to build self-storage facilities in secondary and tertiary markets, which didn't see as much rental rate growth during the pandemic. And as a result, we haven't had to dial back our rates. It's kind of like what we're seeing with the home prices. So in some of those markets like Phoenix, where home prices went insane, they're having the greatest retraction in pricing right now. So same thing with self-storage rental rates, that the facilities that were able to push their rates the hardest are having to retract a little bit, but by no means is it wiping out the gains that were made in rental rates. In terms of delinquencies, no, we have not seen any sort of increase in delinquencies over this time, partially because self-storage is a month-to-month lease in most scenarios, and also because it's governed by lien law, not tenant law. So when you rent a storage unit, you are agreeing to have a lien put on your property. By you putting your things into that metal box, we have the ability to overlock your unit should you not pay. So that sort of cut and dry relationship makes it very easy for the self-storage rental transaction because they know that day one. So if they see the writing on the wall of, I might not be able to keep this unit, they typically self-correct and they move their stuff out. Otherwise, it's something where, we put the overlock on there, we provide them notice telling them that they need to come current with their rental balance. And then if they don't, then we go through the process of auctioning off their belongings. That happens pretty rarely, which is the good news, since we don't want to be auctioning off people's belongings, even though a lot of times it's stuff where they should honestly just be throwing it out, but that's not our call, is it? What we have been seeing, which is interesting, is that when we buy a self-storage facility, often our favorite type of value add for a self-storage facility is that we purchase it and we increase the rental rates. We're able to increase the rental rates because a lot of these mom and pop operators of self-storage, which is about 70% of self-storage operators, they don't do the market audits that we do, where we go ahead and we look at all the competitor self-storage facilities and see where their rental rates are. And then we're able to adjust our rental rates just below theirs to maintain that competitive advantage, but also maximize our profits. So we do that with every self-storage facility we buy. Now, typically our policy has been just rip the Band-Aid off, where we buy a self-storage facility and we immediately raise it up to 95% of market rate. And sure, we get some people that are pretty upset about that, but a lot of people understand that, hey, I've been renting this unit for 10 years. The previous owner has never raised the rental rates on me. It's about time. So that's been fine in the past. What we've been seeing more recent is that there's been a greater response to that. That response being people moving out. Now, the great thing about all of that is that self-storage has a pretty low break-even occupancy. Like an unleveraged self-storage facility has a break-even occupancy of about 30% occupancy. A leveraged self-storage facility is around 60%. So as long as we're above 60% occupancy, we're still going to be able to make all of our expense payments, our debt payments, etc. So a real life example of this is that we bought a self-storage facility recently. We looked at it and we went, holy smokes, these rates are low. Now, the problem for this self-storage facility is that it's the only self-storage facility in town. So we can't do a market audit. We can't go, okay, what are the other self-storage facilities charging? We're going to charge slightly below that. So instead, we had to use statistics. We had to use national data. So we went ahead and we looked at it. It was in Indiana. We said, okay, so Indiana typically garners this dollars per square foot versus this dollars per square foot in expenses. And we were able to extrapolate from that what sort of rental rate increase that we should do. Now, we found out that our rental rates were 1/4, 25%, the state average of rental income. So in theory, to get to market rate, we should have quadrupled the rental rate.
Yeah. Wow.
Now, we knew that wasn't going to work out too well. That wasn't going to make people happy. So we ended up raising the rental rate by 67% day one. Now, this facility was 100% occupied when we bought it. And we typically don't like self-storage facilities to be 100% occupied because that lets us know that we aren't charging enough in rent. It also lets us know that potentially there is pent-up demand in the market and we should be expanding. Now, this is a small town and this was a larger facility, so we didn't think it was a scenario where we should be expanding. It was probably just the rental rates were 1/4 of the state average of rental rate. And so when we raised it 67%, the occupancy dropped from 100% to 80%. Now, typically we like our storage facilities to be around 85 to 90%. So seeing the knife fall and trying to decide, should I try and catch it? It was a little scary, but it's stabilized now at 80%. Now, the good news is that by raising the rental rates by 67%, even though we lost 20% of our renters, we're still making hand over fist more money in terms of the rent that's being brought in. So it was for sure the right move, but it is something where, thankfully, because of the month-to-month structure of self-storage leases, we're going to be able to do reactive pricing, where now that it's been a number of months that we've had these rates, we'll be able to adjust the rates depending on the demand for certain sizes of self-storage to hopefully get it up from 80% to 85 or 90% while maintaining relatively high rental rates.
Wow. Yeah, that's amazing, man. I like the way that you can actually maneuver and do certain things in that business because of the low occupancy break-even point that you have there, whether it's financing or non-financing. And really want to thank you for coming on the show and sharing these jewels with our listeners. And if you guys be sure to check out, let me give you some of his social media handles. as Triple SC. Love it. It's triplesc.com. At Triple SC, at Triple S Equities on TikTok. I know you guys got some great TikTok stuff there. I really appreciate you coming on the show today, Steven, and sharing all this valuable information with our listeners. And this is another great episode of PFREI. I'm your host, Fuquan Bilal. It's been a plum-pleasing pleasure. Any last words for the show?
Just thanks for listening. Thanks for having me on. And if anyone wants to be talking self-storage, feel free to reach out.
Awesome. Appreciate you, man.